Okay, so I wanted to talk to you tonight. Just to reintroduce myself real quick, I'm Sheryl Lucas. I do work with Lou over at Keller Williams. However, I manage 2 offices for H&R Block in my spare time. And I wanted to come tonight to talk to you about the new credit that the government has made available for first-time homebuyers. The way the program works is that first it's for only for first-time homebuyers, and for this special credit, the definition of a first-time homebuyer is someone who did not own a home or have any ownership in a home in the last 3 years. Any other program that you look at, the definition of a first-time homebuyer says the previous 2 years. The government expanded this one. Okay, and what this credit is it is up to 10% of your purchase price or $7,500, whichever one is less. So if you buy a house for $65,000, you're getting a $6,500 credit. You buy a house for $150,000, you're getting a $7,500 credit. Okay, and that is if you're single or married filing joint. Okay, if you're married filing separately and buy a house, then the credit is cut in half and it's $3,750. So what is this credit? What's it all about? It is to encourage people who have been renting or living in other situations and who have been maybe thinking about purchasing a home to do so before July 1st of 2009. Okay, so this credit works on any home that was purchased April 9th of 2008 through June 30th of 2009. Okay, it is available for almost everybody. The people who can't buy it are people who are not U.S. citizens, to be a citizen to buy it. It does not work if you buy your Aunt Betsy's house. Okay? Has to be what they call an arm's length transaction. It can't be a house you bought from a related party. It can't be a house that you bought or that you got because your grandmother died and gave it to you. Okay? Can't be, so it can't be an inheritance. You can't claim a credit on something that somebody on a house that gave you that was a gift. Okay? Other than that, everything works. Okay? So this is a credit. You get the credit when you file your tax return. Okay? But to give you the bottom line out, the real bottom line definition of what this credit is that it is a 15-year interest-free loan provided by the government. Okay? So if you had purchased your house this year, we'll say last year, so it was on 2008 income tax, and you applied for the credit, you would get a $7,000 or $7,500 income tax refund. When you file your taxes in 2010, you have to start paying it back. You pay it back at $500 a year for 15 years, no interest. Okay? So, you know, whether you want to use this money to buy, you know, things once you've bought the house, it's a house that needs to be fixed up. You need to do landscaping. You want that furniture Lou was talking about, $5,000 at Art Van. Buy it after you buy the house. Okay, you can use this home buyer's credit in order to get that. The government really wants to encourage, I don't know if you guys have noticed, but there are a lot of houses that are out there that are sitting, that are empty, that are lonely, that need somebody to love them. Okay, so hopefully this first-time home buyer's credit of $7,500 will help get some of those homes occupied. So like I said, you pay this back over 15 years, you pay it back $500 at a pop in your income tax. If you normally were not somebody that got a $500 income tax refund every year, you might want to adjust your withholding at work. Have them withhold out an extra, you know, $75 a month or whatever it's going to take. So at the end of the year, you've got a $500 refund so that you can use that to pay back your loan. Okay? There are some kind of issues tied to this. If you were to buy a home and lived in it for 5 years and decided that you wanted to turn this home into a rental property because you're leaving to move to Minnesota or whatever, but you don't want to sell your house, when it is no longer your primary residence, the loan becomes due again. Okay? So if you decided to rent it out, if you are married filing joint and you buy a house together, and 5 years into it you decide you don't want to be married anymore, then the person who leaves the house and it's no longer their primary residence, their part of the loan becomes due. The person who stays in the house can continue to pay back theirs over 15 years. So what would happen in that case if you had gotten $7,500, $3,750 of it would be yours, $3,750 of it would be his. So, you know, if you're not occupying the house as your primary residence anymore, then you have to pay the loan back, okay? There is one kind of nice benefit to the loan, and that is that the payback on the loan is tied to how much profit do you make on the house when you sell it, okay? So let's say that, you know, we bought a property for $100,000 and we thought, hey, this'll, you know, it'll be worth 110, 115, 2-3 years from now. You know, I'll be able to sell it and make a profit. If you had lived in there 5 or 6 years and maybe only paid back $1,500 or $2,000 of your loan, and so you still owed $5,000 or $6,000 on this loan when you sold the house, if you don't make $6,000 in profit, then the loan gets forgiven. If you only make $1,000 in profit, you only have to pay $1,000 back. Okay, so that's kind of a nice benefit to it. It's an awful young crowd here this evening, but another kind of benefit to this whole program with the government is that if you purchase a home and you die before you finish paying your credit back, the loan is forgiven. Okay, so I hope that none of that happens to any of you, but you know, at least you know that you're not, if you were to do that, you know, and I was thinking it for myself or whatever, I wouldn't want to leave that kind of a burden on my kids or whoever was going to, you know, clean up the stuff after I'm done. So it's nice to know that, you know, if that were to happen, that you don't have to pay the loan back. So, okay. But it really is to try to, you know, encourage people to, you know, take that plunge. Prices are as low as we've seen them in ages. Mortgage rates are as low as we've seen them in ages. I don't know, Lou, maybe you could agree with me. I have never seen a buyer's market like we're in right now, except that also credit is tight, you know. So, but if you're one of those people that can make all those requirements and, you know, maybe the $7,500 incentive, it is, you know, it is a loan, but it's an interest-free loan. So I don't know anybody that would not want to take it. Any questions on that? You know, we were always told, and I know remember when I bought my first home, and that was many more years ago than I'm willing to admit to, and it was at more than twice what the interest rate is you're talking about today. And I remember the first time it came up for refinancing, and the mortgage company told me at that time, you know, historically, anything below 7 is a good rate. And I think historically, anything below 7 on a 30-year fixed mortgage is a good rate. You know, so, but it you know, it really changes how much house can you afford. You know, the lower the interest rate is, the more house you can afford to buy.